Gross domestic product. In most of the developed world, countries grow their GDP, which is like a measure of a nation's wealth, by focusing on three levers. The first one is immigration. Politicians will prioritize people they can import over natural population growth because it's an easier way to goose the numbers. Secondly, there's productivity growth. This is what entrepreneurs and everyday people have in common. We all want more from less. Like all types of mining, though, where we take some materials and we try to make something of higher value out of it, there's often slightly less return for each new unit of effort that's being applied. The last lever is debt growth. Over time, debt of all sorts has to increase. If not share, bond, property, or crypto markets, it's war, and it's an endless reason why we have to spend money on infrastructure. Financialized assets need to soak up the new credit creation that must occur at increasing speed over time. And if it doesn't happen, a supermassive black hole sucks us back to the dark ages. Financially speaking, of course. Welcome to the show today. This is a version of how the world works, which isn't perfect, I know. Mildly offensive in some parts, I'm sure, too. But it's a microdose of macroeconomics. You can focus on the fees, or you can focus on the returns. And should you choose the latter, there's a few things that you should know along the way. And don't worry if you feel a bit dumb learning about this stuff at the start. A conversation that will help you along your way today, though. Hugh Hendry is a Scottish ex-hedge fund manager, well known for his performance during the global financial crisis of 2008. Today we'll be covering off how he is thinking about his portfolio during these times, how he's investing. Remember not to conflate edutainment with a bit of financial advice, though, today. Now, occasionally I'll reach out to people like this who have slightly off-balance views on investing because they're often easier to learn from. And if you know of anyone you'd like me to approach or you can introduce me to, I'd love your help. Connect with me through most social channels and we'll see what happens. Okay. Now, it often takes a while for conversations to get going, so I think we're joining back into the discussion around a really interesting part. I hope you enjoy it. Let's get started. You're listening into the Everyday Investor Podcast. Passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. Presumably, you would be figuring out what kind of positions you would take to benefit from this environment that, of course, you can't control. You know it's just going to happen. So can you just walk me through how you would potentially set up your portfolio in light of what you're just talking about, but maybe even factoring in some of the other dynamics at play right now?
Yeah, so let's keep to the old weather, what I call a kind of quadratic risk expression. It's the diversification of risk. There are points where you step up and you take a lot of risk, but you want to have a coherent, systematic approach to both seeing the opportunities and scaling up the opportunities. So if I was running a 100 million NEV portfolio today, the most remarkable thing, the thing that some of your audience would recognize is I wouldn't really have to spend a dollar to be represented in markets. Think of a compass point: north, south, west, east, whatever, or God bless you.
Yeah, let's do that one. Yeah.
God bless you for investing with me, So, the first one really would be the S&P you can play around in all the silly stock indices, the DAX, the NASDAQ, whatever, but it's the S&P. We're going to think of a risk allocation there. And for most of this year, my allocation has been about 20%. And I'm maybe wanting to pull it back a little bit now, maybe 15. I'd maybe want to be doing protective option overriding because, the NASDAQ's up 40%. S&P unweighted is up about 10. Unweighted, where you have, the Amazons and the AI stocks. Again, it's had a fantastic tear, but trending positively. I've got to have an equity allocation. It'd be between 15 and 20% of my NAV because I feel like I've got to be diversified. It is trending. That's all. There's not, and then you could say that you're up trying to short the S&P. You're up against a formidable opponent, which is the 401k program. I mean, the S&P just trends. It trends with a Sharpe ratio, which is insanely high, and periodically every 3 years it just goes boom. It's like a tombstone and it falls over. But intellectually, the thing where I'm seeing potentially opportunities is in the risk-free US Treasury market. It's been downgraded, so how risk-free is it? But there's been a lot of drama. Think of me as Johnny Drama. I like drama. In price terms, we've eliminated 15, 16, 17 years of price gains from long duration, long dated US securities. And you can imagine because of this fear, foreboding of the inflation that we've had and the expectation that it's going to prove sticky. Sticky is this new term, I used to eat sticky puddings, but now everyone talks about sticky inflation. It's just
I thought you were going to say sticky something else.
Rolling Stones. No, stop it. Right. Okay. It's had like a 3 standard deviation negative price movement. And in the world of global macro, you're kind of looking for signals of that nature, 2-3 standard deviations, price waterfall events. The S&P was there in March 2009. They're very uncomfortable places to seek to purchase. There are many reasons you should not be buying, but the best reason is they've had a 3 standard deviation drawdown, and we live in a monetary system which seems to reward mean reversion. So I kind of feel like I don't buy the inflation thesis because we were kind of pointing towards the psychology of the monetary phenomenon necessary to sustain inflation. And today, inflation really requires that the global workforce continues to be rewarded with higher and higher rates of compensation.
Right.
And so the tailwinds against that would be that you have the gigantic mercantilist nation of China. I say gigantic, it's now the size of Europe. And China just will not tolerate the wages of its domestic labor pool matching those of productivity. So labor is always structurally cheap in China. It's one of the structural kind of parts of their system which favors exports and profoundly large trade surpluses. Trade surpluses which are 3 times greater than anything you see from the 19th century. I mean, truly remarkably high. So that's really hard. It's really hard if you're in Australia, Europe, the United States, and across industry you are raising the price of labor. Labor's going to disappear. It's just,
Right.
You're just going to facilitate this. Now you could say, well, yeah, but we're now doing onshoring. We're doing a little bit of it, but onshoring would take you 30 years. So, and then they say, well, it's marginal rate of change. Anyway, for me, I don't see enough risk-seeking behavior from banks, and I don't see the Chinese authorities changing their practice with regard to their labor pool or indeed their currency. Their currency is proving a little bit weak, and that just adds to the pressure on Western labor markets. So for me, the inflation is, we had a pandemic, we closed everything down, we sent people checks, demand was greater than supply, prices went up, and it's taking about 2 years to work its way out of the system. As it does, you can see, you're just kind of seeing forward prices via producer prices. Producer prices are collapsing. They're collapsing. So that would be my bet. So I'm not an inflationist. Prices have fallen dramatically, but I can't buy them because I need the legitimacy of a price trend. And so I've got to squiggle a little bit, and I come in and I buy options. I buy the TLT, which is an ETF. It's 17-year duration treasury bonds.
Yeah.
I can buy options on it expiring in January of 2025. I start buying them this year in March. I've only lost money since March. But think of the terms involved. So what did I say? I had 100 million hedge fund. I got 20 million in S&P stroke NASDAQ. And here we're talking about putting 7 million in option premium. So it's,
and you're talking about call options specifically, right? On the TLT.
Yeah. I mean, so I'm close to the money. TLT price was, I want to say 96, 97. My head spins, it's come down from 100. And, and the folks that follow me on Twitter are like, oh, this has been a terrible trade. I'm like, dude, it's August of 23. Okay. I've only had them on for 4 months. It's like, maxi slow. It takes a long, U.S. economy is $25 trillion. It takes a long time for, if it's losing its mojo, it takes a while, and that's an important thing with macro. We're not traders. We're not like, we'll make money in July. We'll make money in August. It's like, I've got a landing strip, which is 2 years.
Yeah, that's surprising for me because I kind of always assumed it would be always short term, always in the now. But talking about a 2-year time frame like this kind of goes counter to that. That's for sure.
Yeah, I mean, it's mostly like that. In 2008, I enjoyed a good year. I made 33%. I made 50 in the month of October 2008. But that all stemmed from a position that I had committed to in May of 2007.
Okay.
It takes a long time to bear fruit. And you've got to survive just the craziness of markets, Lehman Brothers went bankrupt 2 weeks prior to that. The share price series of US banks made an all-time high. You can't make that stuff up. So anyway, so I've got 200,000 less in 200. I've got 20 million in S&P. I've got 7 million in treasury bond futures. And I have to say, just in terms of education and stuff, it's not good just to buy call options or just to buy put options. Any option is overvalued and like really richly overvalued. The
house has to always win. Yeah.
Yeah. The richest people in the world are the people who write you the options.
Yeah.
And so when I say I've got these 100 strike calls, that's true. But in the short term, I'm writing a lot of calls and puts. So I'm trying to do something about the old, like I'm trying to cheapen the cost of my submission.
I hear you.
And I can cheapen it because, again, I'm kind of, if you will, willing to forgo. I don't think my strategy is going to like explode to the upside this month. So short dated. So if you will, I'm committed and I own expensive, overvalued, long dated options.
Yeah.
And I try and cheapen it by selling both calls and puts depending on where we are. If we're trading 102, then I'm selling 102 calls. If we're trading 98, then I'm selling, 98, 96 puts. Anyway, next quadrant would be alternative assets. And that's where you find gold, Bitcoin, commodities, real estate, private equity. That's $100 trillion quadrant. I would have to have about 5 million in gold futures.
Okay.
Gold has been here or hereabouts for the last 12 years. It's at a kind of barrier of just above 2,000. Macro is all about barriers, price levels, kind of going sideways for like a decade, 2 decades. But when the price breaks them, boom, they go higher. So I've got 5% in gold because of everything that's going on.
Yeah.
They are issuing more of those treasuries. Fitch is saying that this is not good. I think we're going to see a big slowdown in the economy. What do they do next, kind of thing? So gold is a bit of an insurance policy. And secondly, gold is typically expensive because you're getting paid interest, and again, you're getting paid, 5.5% by the Fed. You get paid nothing in gold. But on the other hand, asset prices are kind of, the level of asset prices suggests that the 10-year expected return on equities is 0 at best. So actually, gold's not that scary. It's like, anyway, so I'd have 5 in gold. Gold is something I'd want to layer into. I want to buy another 5 at higher and higher prices. I don't think it can trade much beyond 3,000 because of the starting point.
Sure, but largely that's an insurance strategy more than hoping to get a good gain. You've just got an analog version of, hey, if everything goes to hell in a handcart, this will pay out.
Yeah, but again, it's recognition of very long-term price charts, and the very long-term price chart says, push come to shove, you got to have something here in case it breaks the barrier. Asset classes which break barriers and trade higher can have explosive movement. So gold ticks that box. But I'd have a much bigger position in Bitcoin.
Okay, tell me about that. Yeah,
I would have 20 million there, and the reason is it's just preposterously small.
Yeah,
first, like gold is preposterous. I mean, what is gold? Is is it something that came from a meteorite? People will wax lyrically, but you know that there is someone somewhere in the world that's always willing to pay you quite a lot of money for the yellow metal. And kind of, we don't have thousands of years of data, but it looks as though Bitcoin is going to be the same.
Yeah, that's right. Yeah, well, that way, just on that, Hugh, like many people in your space, there would have been a point in time where you weren't on board with Bitcoin. Maybe you didn't understand the thesis, or you just need to see a longer time frame, or you need to see the market cap grow. But what was it that caused you to kind of flip the switch on Bitcoin?
Again, it's kind of having this quadratic impression of asset allocation, being in it to win it. Yeah, the fact that asset classes are so rich across the world. The fact that Bitcoin had another mean reversion. It did fall from 70,000 and it came all the way down to 17 or so thousand, 18,000.
Yeah.
So that's mean reversion. And then the sheer, the total market valuation of Bitcoin, it's only, I don't really include crypto in my world.
Good. Yeah.
I'm less interested. Bitcoin, the market value is about $500 billion.
Yeah.
So it's 1/26 the size of gold. And I still believe crazy things do happen, will happen, probably will happen even more. And so I want to say it has convexity. I mean, Bitcoin could trade 4x higher, and it really wouldn't have a ripple or an impulse it wouldn't have an impact onto other asset classes. If gold is $13 trillion, if gold triples, it's bigger than all US stock indices. Yeah. So that's, I'm like, that's a head scratcher. I like gold, but really it's going to be bigger than all equities. Whereas if that happens to Bitcoin, then it would be $1.5 billion, be the same size as Meta, Facebook. Okay.
So better reward for the same potential catalyst. Like if we equate gold and Bitcoin, similar in terms of their use case as a diversifier, I guess you could say, right?
Yeah, and again, this is all coming against the backdrop that, we invented a financial system which used treasury bonds as collateral, and U.S. government now is printing a lot more of those collateral treasury bonds.
Yeah.
And so that system may be on the throes of becoming inflationary. I take issue with people who say it's now. I think it's close, but the bit between, it's a bit like on options. You also have this dead zone before you make a lot of money, and I think we're entering into the kind of drop dead zone, and then you get your inflation. So whatever. Okay. So they have relevance. They are alternative currency assets, if you will. Bitcoin is the smallest. It seems to have demonstrated proof of concept. And then finally, is woken up the greedy denizens of Wall Street. The guys who like Wall Street is a machine. It makes money because it's not a machine. It's a casino.
Yeah,
and there's a lot of casino owners that are like, let's do Bitcoin. Like so. What I'm talking about, we now have a Bitcoin future. It looks like we're going to have ETFs. And together they will, and they're being supported by the most gigantic financial behemoths, and they employ thousands of people, and they're going to be on the phone with hundreds of thousands of people, and it's going to become a kind of George Soros reflexive system. So there I say to you that I would buy in clips. I'd buy more Bitcoin going down. So I'm saying to you, my treasuries, they're trading kind of 100, and as they trade close to 90, I'm a buyer. Yeah. My NASDAQ, I only own it because it's going up. I think it's valued, but it's going up, and I respect uptrends. If it loses its uptrend, I'm like, get me out of Dodge City. I'm a seller. Gold, I said to you, I'm a buyer on incremental leaps higher.
Yes.
Bitcoin, I'm a buyer on incremental latches downwards.
Yes.
I want to, if I was going to trade 10,000, I want to maximize my position. If I'm starting at 200,000, I would want to think that I could be at 400. If I was starting at 20 million, I'd want to be 40 million if it traded as low as 1,000. And then finally, we've got a final quadrant, which is cash.
Yeah.
And all of those transactions, they haven't really cost me any money because I bought futures.
Right. Okay.
So again, if I'm a hedge fund, I'm still sitting with $100 million. Actually, I've probably posted 2 or 3 million for the treasury call positions. So I'm sitting with 98 million in cash, and I'm getting 5.5%.
Yeah.
So for hedge funds and stuff, like this year's kind of pretty okay. Macro's not trying to beat the beta of the S&P or the NASDAQ. And you're starting a year where you get like 5% like positive on your cash.
Hey, it's cool. Yeah, it's pretty cool. Like it's something that I think, like for myself and for the people that I talk to, it feels kind of like everyday investors are told to dollar cost average into a very well diversified fund and just to sit tight and shut up. And no disrespect to that whole industry because I'm in that, but I think when it comes to looking at this from a macro framework, I'm just wondering, why is it that everyday investors don't kind of play the investing game using a similar sort of framework that you've just described? And like, why do you think that is?
Oh, because you get sold financial products. No one buys them. Some guy phones you like, hey, hi, George, do you remember me? We had a drink at the golf club. And plus everyone's busy and it's a little bit scary. They use all these terms, people think the central bank's like a genius. They're idiots, but and so, I mean, my business is, if you are, I'm a financial influencer these days. I'm seeking to socially influence people to try and wake them up and say, you should kind of do it.
Yeah. Well, tell me about that, Hugh. Like, what are you doing at the moment in that space? Because I know from your hat, you're the acid capitalist, but tell me a little bit more about what you're up to.
Well, I mean, as you know, I was a global macro hedge fund manager, had my own business out of London. I ran a hedge fund for 15 years. My engagement with the sector started 25 years ago. So, I've got a lot of experience. Hedge funds became over-regulated. I'm passionate. Hedge fund investing is just a wonderful thing for curious minds. I mean, I'm like curious all the time. I keep asking questions, and questions make, I don't know, prizes in the world of speculation. But it became, I lost it was joyless. I had passion, but it was joyless. I invested. I'm here in St. Bart's, and I invested in the local property market, and I saw very similar characteristics to Bitcoin. It's scarce. They have a halving concept where the supply literally the supply does diminish because the permits that they issue, they're not issuing, and so the existing stock becomes more sought after. And your clients pay you in dollars, your expenses are in euros. I was looking to borrow from French banks over 20 years at 2%, and I there's a view of the world, a view where Bitcoin trades at $150,000 or gold trades at $4,500. That's a world where the shareholders of the bank have transferred their wealth to me via the mechanism of the mortgage. It's leveraging real assets. And then I got this calling again. I still hear these voices in my head, and so I've got a Patreon account. I'm doing a weekly podcast with people that make me think. Patreon, people can get a one-on-one mentoring scheme with me. It's amazing the stories that I hear, and the journeys that they take me on. I'm about to host a summer camp here in St. Bart's. There are lucky few. They're going to stay in my properties here. I sell these hats, and who knows what else, I should really be managing money again. That's where the money is, baby.
Yeah, well, maybe this is the next manifestation of how we all should be doing it here. Who knows?
Yeah. We can all do it this week.
Yeah. There is just one more question before we go that I'd really love to pick your brains on, because it's something I think a lot about. I'm quite into property myself, and to understand where property values go, kind of need to understand where interest rates are going to go, kind of like bonds, I guess. And that leads you on a little bit of a chase. And you kind of have to hunt down some of the things that move interest rates around, not just here in New Zealand where I'm living now, but worldwide, because everything increasingly seems to be connected. So from your perspective, and I vaguely kind of understand how this works, but maybe if you could explain it, just with Japan and China unloading more treasuries potentially, can you talk to me about how that might influence interest rates? Or if there's anything else that you can pick on that might influence interest rates, say, in the next 1 to 2 years?
Sure. I think that's the best, most complex way to close the show.
Yeah.
We have to be cognizant of how exceptional this rate hiking period has been within America, because the private sector has been immunized. It has not felt these higher rates, which is why the economy just has not pulled back. We haven't had a recession. It's been the sharpest, fastest tightening of policy in 25 years. And if you will, Atlas shrugged. Mark went, okay. But there are consequences. And to answer your question, no one, this is a very US-centric answer, but no one can afford to move house. If you move house, then you have to cancel your existing mortgage, struck at 2%, and take on a new mortgage. And I saw figures that if you take on a new mortgage and you buy the average house, if you will, the average house price transaction, and you take a new car loan for the average car loan, and so you reset higher to where, if you will, Fed rates plus risk premium are, 2/3 of your income, 2/3 of your disposable income are swallowed up by your house and your car.
Yeah.
And of course, insurance is very expensive. Health insurance is very expensive in America. You got to feed yourself, God help you if you've got kids and education and all that as well. So I feel like just now the US is subject to kind of slow form of asphyxiation. It's like just gently slowing down. I mean, at some point, people have to buy cars and they have to move house. You got to move state. You got to do things.
It's kind of like they're holding their breath, right?
They're holding their breath. The asphyxiation, yeah. So, and at the same time, the federal government, you've had a very surprise slowdown in federal tax receipts. Partly because asset markets were so strong 18 months ago, and the anniversary that's rolling off, but it's really caught them out. Deficits are actually going up as a percentage of GDP, and the economy has not had a recession. And so people are like, and their interest payments now are on the verge of usurping what they would traditionally spend in sensitive sectors such as defense. So again, you've got the private sector, which is kind of okay, but it's kind of losing oxygen. And then you've got the public sector, which really has some serious thinking to do about retrenching and perhaps spending less. Yeah. So I think a slowdown will come in the US. At the same time, you've got a huge amount of financial institutions, and they borrow short and they lend long. Because you had you had very, very low long-term interest rates for 15 years. You've got a huge legacy of mortgage and other corporate debt, which now has to trade way below NAV or par because it was struck at the wrong price. So there's, if you will, there's hidden instability in the financial sector. So I'm not convinced we've seen the last, financial accident. And of course, the manifestation of that is weak credit growth and a lack of risk appetite everywhere outside the stock market. So US is like amber. And then in terms of housing, where you are in Australia, Canada, and the UK, I think you've got to be anticipating serious pullback in house prices. You've had a generation of people that did the buy-to-let. Buy-to-let does not work. And it doesn't work if you're renting it, and so it means that a lot of properties are coming on the market to be sold. And again, who's going to buy it? Because rates are really high.
It's all kind of pointing to the same thing. Higher rates, potentially less credit growth. There's little incentive for people to move on. So I guess it's a question of how long can everything, it's not just people, but how long can everything in the system hold its breath for while we maintain this high interest rate setting. So I guess, what is the ultimate cure then? Like, where do we need to be for stability to come back and for normalcy to reign again?
Yeah, we mentioned in passing China, but these very large export-dominated economic blocs, they have currencies which depreciate against the US dollar. They run persistent surpluses. It would be good if their currencies were rising, their consumers were becoming richer, and they were buying goods and services. So that's not happening. There's a profound structural deficit in demand for goods and services, because the rest of the world should have currencies which are stronger vis-a-vis the US dollar, but they don't. And they don't because the US buys their goods and services, so it addresses their overcapacity issue. And in return, people like China, because you said, what if China and Japan sell treasury bonds? They won't. Yeah, if they sell treasury, I wish they would. I would ban them, but I wish they would, because every year it's the avalanche of buying treasury and other US dollar risk-free securities, which keeps the dollar strong vis-a-vis them. So they buy financial assets. So the true cause, in my head, of the asset price inflation is the organization of international trade. I think we're just in a rinse and repeat cycle where the system needs more and more debt. Presently, the cost of the debt has been set, I think, too high. We've talked about asphyxiation.
Yeah.
I think the cost of debt will have to come down. Fed and other central banks will cut rates. That will facilitate more debt accumulation and therefore more economic growth, but more economic volatility. And that's to be determined what happens next.
Yeah, but ultimately, if other currencies can appreciate in value, maybe there's wage inflation in developing countries, and maybe that wealth gets spread more evenly rather than I'm going to lose this bit so I can gain that bit.
Absolutely. I mean, I would much rather trade future wage inflation for the household sector to try and do away with this grotesque income inequality. I would trade that for higher asset prices.
Yeah. I think everybody would. Yeah.
The people who write the big checks for the politicians are the asset guys and girls. They're like, no, give me hawkish central banking, So we're going to have to burn the whole thing down before we get any chance of, we've got too many people disenfranchised.
You
can see politics are just becoming kind of really complicated.
Well, it's like when the music's over, turn on the lights, right? It feels pretty close to that, doesn't it?
Well, let's keep on Jim Morrison. What have we done to our fair sister? We've ravaged and we've pillaged her. It's time to take care of our sister and start doing proper things. But it's the problem. It's a little bit Professor Michael Pettis, one of the greatest minds on current international trade policy and other matters. China's in this terrible dilemma because the internal policies that have been responsible for taking it from less than the size of Turkey to greater than the continent of Europe, those policies don't work anymore.
Right.
But they rewarded lots of vested interests. And to get everyone aligned and say, look, we're going to change this. The reward system's going to change. It's going to be good for the nation, but I'm afraid, Wang Hu over here, like, yeah, you've made enough. And Wang Hu's like, no, not me.
Yeah. It's a tough sell. Okay. Well, maybe that is part 2, Hugh. We'll dig into that more another time. But I really wanted to thank you again. Thank you very much for speaking with me. And for people that want to follow you on Twitter, X, how can they find you there?
Yeah, X marks the spot. Hendry_Hugh.
Awesome.
And the Asset Capitalist Show on YouTube and on the podcasts.
Fantastic. Awesome. All right. Thank you again, Hugh. Enjoy the rest of your day there in St. Bart's.
Thank you. Take care. I enjoyed it.
Take care. Thank you. Same here. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.